This is the house you were supposed to want. 4 bedrooms, 2.5 baths, a kitchen with an island, good school district, a neighborhood where everyone parks their cars in the garage and keeps the lawn edged. And here's what the bank told you when you went in to talk about it. Congratulations. Based on your income, you qualify for up to $620,000. And there it was, $620,000. Not a warning, not a ceiling. A number that felt like permission. Like the bank was handing you a ticket and saying, go ahead, you've earned this. So you bought the $580,000 house. Because you were being responsible, you didn't max it out. What the bank did not tell you, what no one in that transaction had any financial incentive to tell you, is what that decision was going to cost you over the next 30 years. Not just in mortgage payments, in retirement savings you couldn't make, in market returns you'll never see, in a version of your financial future that quietly closed the door while you were picking out countertops. Today I'm going to show you the full math, not just the mortgage, the whole picture, the property taxes, the maintenance, the lifestyle creep, the opportunity cost of the down payment, the cash flow squeeze on your retirement contributions. Every single mechanism by which a too expensive house transfers your wealth to everyone except you, and then I'm going to give you a framework that you can actually use, whether you're still buying, already in, or wondering if it's time to make a change. This is not an anti-home ownership video. Buying a home can be one of the best financial decisions you make, but buying too much home is a different story entirely. Let's get into it. Section 1, reframing the question. Before we run the numbers, I want to reframe the question most people are asking when they buy a house. Most people ask, what can I afford? And what they mean by that is, what's the maximum mortgage payment I can make each month without completely blowing up my budget? That's the wrong question. Not because it's dumb, it's actually the question the entire real estate industry is designed to get you to ask. It's the question that keeps agents, lenders, and appraisers in business. The right question is, what does this choice cost me in the long run? And those two questions have very different answers. Here's a concept I want you to hold on to for this entire video. Opportunity cost. Every dollar you spend on housing is a dollar that isn't being invested somewhere else. Every dollar that doesn't get invested is a dollar that doesn't compound. And every dollar that doesn't compound is $10, $20, $30 you don't have in retirement. Housing costs don't just cost you money. They cost you the future value of that money. Keep that framing in your head, because every number I'm about to walk you through needs to be evaluated not just as a dollar figure, but as a dollar figure with a 25 to 30-year compounding multiplier attached to it. Section 2, the hidden math of ownership. Let's start with what I call the iceberg problem. When people compare housing options, they compare mortgage payments. House A has a $2,200 a month payment. House B has a $2,900 a month payment. The difference is $700. That's how most people think about it. What they're looking at is the tip of the iceberg. Everything below the surface, property taxes, insurance, maintenance, utilities, HOA fees, is invisible in most buying conversations. And the bigger the house, the bigger the iceberg below the surface. Let me build this out with real numbers. I'm going to compare two houses in the same market. House A is $350,000. House B is $550,000. A $200,000 difference in purchase price. This is a very common scenario. You qualified for more, so you bought more. The mortgage. At 7% on a 30-year fixed, House A runs about $1,980 per month. House B runs about $3,130 per month. That's $1,150 more a month just in principal and interest. Over 30 years, that's $414,000 in additional mortgage payments. Already significant. But we're just getting started. Property taxes. In most of the country, property taxes run somewhere between 1% and 1.5% of assessed value annually. On House A, that's roughly $3,500 to $5,250 a year. On House B, it's $5,500 to $8,250. Call the annual difference $3,000 over 25 years, and we'll get into why property taxes grow. That's $75,000 at minimum, and we'll talk about why the real number is much higher. Homeowners insurance, more house, more coverage required. the gap might be $600 to $1,200 per year between these two homes. Over 25 years, that's $15,000 to $30,000. Maintenance. Here's one that really surprises people. Financial planners typically estimate home maintenance at 1% to 2% of the home's value per year. On a $350,000 home, that's $3,500 to $7,000 annually. On a $550,000 home, that's $5,500 to $11,000 annually. The difference is $2,000 to $4,000 per year. Over 25 years, that's $50,000 to $100,000 more that comes out of your pocket to keep the bigger house intact. Utilities. More square footage means more to heat, cool, light, and maintain. The average gap between a modest home and a larger home in utility costs can run $200 to $400 per month, $2,400 to $4,800 per year. Over 25 years, that's $60,000 to $120,000. Let's add that up conservatively. Mortgage differential, $414,000. Property tax differential, $75,000. Insurance, $15,000. Maintenance, $50,000. Utilities, $60,000. We're already at $614,000 in additional cash out of pocket over 25 to 30 years, from a $200,000 difference in purchase price. But that's still only what you paid. Now let's talk about what you didn't get to invest. If instead of paying that $1,150 per month mortgage differential, you had invested it every month for 25 years, earning 9% average annual returns, you would have accumulated approximately $1.2 million. That is the opportunity cost. The $200,000 home upgrade didn't cost you $200,000. Accounting for everything you paid and everything you didn't get to invest, it cost you somewhere north of $1.8 million in final net worth. The bank told you the payment, they never told you the cost. Section 3, the down payment trap. Now let's talk about something that happens before you even make a single mortgage payment, the down payment. On that $550,000 home with a 20% down, you're writing a check for $110,000 at closing. On the $350,000 home, you're writing $70,000. The $40,000 difference doesn't sound enormous in the context of a $500,000 purchase, but let's put it through the same lens we've been using. $40,000 invested in a diversified index fund at age 32, left alone for 30 years, earning 9% average annual returns. That $40,000 becomes approximately $531,000. $530,000 from $40,000. That wasn't spent, it was locked into a house, an illiquid asset, an asset that you can't easily sell part of if you need money. An asset that requires constant maintenance spending to preserve its value. I'm not saying don't put a down payment down. A down payment reduces your interest costs over the life of the loan and helps you avoid PMI. Those are real benefits. I'm saying that a bigger house requires a bigger down payment, and a bigger down payment removes money from the most powerful compounding environment available to ordinary people. A diversified, low-cost, tax-advantaged investment account. The bank celebrates when you bring more cash to closing. That money is no longer working for your retirement. It is working for your home equity, a different thing entirely. Section 4, the monthly cash flow squeeze. Here's where the damage becomes chronic rather than acute. It's not just the down payment, the mortgage, or the maintenance. It's what high housing costs do to everything else. A household earning $120,000 a year has roughly $7,500 a month in take-home pay after taxes and basic benefit. Financial planners broadly recommend keeping total housing costs, mortgage, taxes, insurance, at 28% of gross income or below. That's about $2,800 per month. Our $550,000 home, with taxes and insurance included, is probably running $3,600 to $3,800 a month. That's not catastrophic, but it's $800 to $1,000 a month over the recommended threshold. And that $800 to $1,000 has to come from somewhere. In the early years, the first couple years in a new home, it usually comes from cutting retirement contributions. You tell yourself it's temporary, just until you settle in. You'll ramp them back up in a year or two. Studies consistently show this doesn't happen. The spending expands to fill the space. The lifestyle adjusts upward. The retirement contribution never fully returns to where it was. Let's look at what that costs. If you contribute 15% of your income toward retirement from age 28 to 65, you might accumulate $2.2 million. If housing pressure causes you to drop that to 7% for just the first 5 years, just 5 years, then back to 15% for the remaining 32, your final balance drops by $380,000 to $450,000. Not because you made bad investment choices, not because the market let you down, because your house payment was $800 too high, and it ate the early years of your retirement compounding. Early years matter most. That's the whole thesis of compound growth. The early contributions have the most time to grow. Interrupting them is disproportionately damaging. Section 5. Lifestyle inflation. Anchoring. Alright, we've covered the financial mechanics. Now let's talk about something that doesn't show up in any spreadsheet but is arguably the most expensive thing about buying too much house: the lifestyle it creates. A bigger house doesn't just cost more to run, it costs more to fill, and to maintain the appearance of, and to live up to. This is what behavioral economists call anchoring, and it happens automatically without conscious decision. When you move into a 3,500 square foot home, your reference point for normal shifts. The furniture you had in your last place doesn't fit, not just physically, but aesthetically. A sectional sofa that looked fine in a 1,400 square foot house looks shabby in an open concept great room with 18-foot ceilings. So you buy new furniture, not because you needed to, because the house required it. And then there's the neighborhood effect. Human beings are deeply, almost embarrassingly social about status. We compare, we calibrate. If your neighbors drive a Lexus SUV and you pull into the driveway in a 12-year-old Civic, there's a low-level but persistent psychological friction. Nobody says anything, but you feel it. A lot of car upgrade decisions aren't actually about the car. They're about the house you bought. A lot of we should host more decisions aren't actually about hospitality. They're about having a house that implies a certain lifestyle and needing to perform that lifestyle to justify it. I've talked to dozens of families about this, and the pattern is remarkably consistent. After buying a home that stretched their budget, they also spent $15,000 to $40,000 on furniture and decor in the first 2 years. Upgraded one or both cars within 3 years of buying. Started eating out more because the kitchen expectations of a nice home somehow make cooking more elaborate and exhausting. Signed the kids up for more activities because the neighborhood calibrated what normal parenting looked like. None of these expenses showed up in the mortgage calculator. All of them were predictable consequences of the purchase. The house didn't just cost more, it pulled their entire cost of living upward, and every dollar of that upward pull was a dollar not compounding toward retirement. This video is sponsored by JoBop, a powerful way to earn consistent and residual income. If you're creating content, building a brand, or even just getting started online, monetization can feel overwhelming. That's where JoBop comes in. Their affiliate program connects you with a high-converting offer you can share with your audience and earn commissions for every successful referral. What I love about it is how simple it is. You sign up, get your custom tracking links, and start promoting a real product everyone needs. No complicated tech, just a straightforward system designed to help you earn while providing real value. Whether you're on YouTube, TikTok, Instagram, or running a blog, this is a practical way to build an additional income stream. And the best part, you're not selling something random. You're promoting a product that everyone needs and can genuinely help people. If you've been looking for a smart way to diversify your income, this could be your move. Click the link in the description to learn more and get started. Now let's get back to the video. Section 6, the maintenance time bomb. Let's get specific about maintenance, because this is the cost that blindsides people most consistently. The 1% to 2% annual maintenance rule sounds abstract until you start listing what it actually covers. A roof replacement, $12,000 to $25,000 for a modest home, $25,000 to $50,000 for a larger one. Roofs last 20 to 30 years. HVAC replacement, $8,000 to $15,000 for a single unit. A large home might have two. Systems last 15 to 20 years. Water heater, $1,500 to $4,000. Last 10 to 15 years. Windows, $400 to $800 per window. A larger home has more of them. Exterior paint or siding, $5,000 to $25,000 depending on size and material. Driveway resurfacing, deck replacement, appliance cycles, plumbing repairs, electrical panels. Every system in a house has a lifespan. And in a bigger house, there's more of every system. Here's what makes this a time bomb. These costs don't come when it's convenient. They come when something breaks. The roof doesn't fail on a month when you have $18,000 sitting in a savings account. It fails on a Tuesday in November, right after you paid for 2 kids' activities and holiday travel. So you put it on a home equity line of credit, or you defer it, which makes it more expensive when you eventually can't defer any longer. The bigger the house, the higher the maintenance baseline, and the larger the financial shock when something major fails. Now run this alongside the cash flow squeeze we talked about earlier. You're already putting less into retirement than you should because the mortgage is tight. And then every few years, a $15,000 or $20,000 maintenance event hits and wipes out whatever small savings cushion you had managed to build. The smaller the house, the smaller the bomb. It's not poetic. It's just square footage times cost per square foot, repeated over 30 years. Section 7, Property Tax Acceleration. Here's a cost that is guaranteed to grow and that most buyers dramatically underestimate: property taxes. When you buy, the property tax amount is based on the current assessed value of the home. But assessed values don't stay still. In most markets over time, home values appreciate, which means assessed values rise, which means your property tax bill rises with them. In many states, there are limits on how fast assessments can increase. In others, there are not. Either way, the direction is almost always up. On a $350,000 home that appreciates to $500,000 over 20 years, your tax bill grows proportionally. On a $550,000 home that appreciates to $780,000, the absolute dollar increase in taxes is significantly larger, even if the percentage rate stays identical. The more expensive your starting point, the more dollar exposure you have to that appreciation-driven tax growth. Over a 25-year horizon, a household in a moderately taxed state might see their annual property tax bill double or more. Someone who started at $4,000 a year in property taxes ends up paying $9,000 or $10,000. Someone who started at $8,000 ends up paying $18,000 to $20,000. That's $10,000 to $12,000 more per year in retirement age, when presumably you were hoping your fixed costs would be lower. Property taxes are the one housing cost that doesn't go away when your mortgage is paid off. They're permanent. They grow. And starting higher means compounding higher forever. Section 8, the compounding cost total. Let me now give you the full picture in one place. The complete, honest accounting of what a $200,000 difference in home price costs over 25 to 30 years. I'm going to be conservative in every single one of these estimates. Additional mortgage payments, $414,000. Opportunity cost on the down payment differential, $40,000 not invested for 30 years, $531,000. Additional property taxes, insurance, and utilities over 25 years, $150,000. Additional maintenance costs, 1% on a $200,000 larger home, $200,000. Opportunity cost of the cash flow squeeze, reduced retirement contributions of $500 per month for 5 years, with 30 years of foregone compounding, $320,000. Lifestyle inflation anchoring, conservative estimate of $30,000 in furniture, car upgrades, and additional spending triggered by the larger home, $30,000 directly, with opportunity cost over 20 years of another $100,000. Approximately $1.7 million from a $200,000 difference in purchase price. I want to be fair here. The more expensive home likely appreciated more in absolute dollar terms too. But in most markets, after accounting for real appreciation rates, transaction costs, and the carrying costs above, a home is not a particularly good investment compared to a diversified stock portfolio. It's a place to live. And the question is, how much of your wealth do you want to tie up in a place to live? Section 9. The mindset shift. It's a consumption choice. I want to stop here and address the objection that I know some of you are forming. But real estate always goes up. My house is my biggest asset. I'm building equity. Let me unpack this carefully, because there's truth in it and there's myth in it. Yes, home values generally go up over long periods. Yes, you're building equity as you pay down your mortgage. Yes, you can eventually sell and access that equity. But here's what building equity actually is. You're making forced savings into an illiquid, non-diversified, actively managed, by you, unpaid asset that produces no income and generates ongoing costs. Compare that to a stock index fund, liquid, diversified, passively managed at near zero cost, and historically compounding at 9 to 10% annually. Housing, net of costs, has historically appreciated at roughly 1 to 2% per year in real terms. That is not a great investment. That is barely keeping pace with inflation. The gains feel large because the asset itself is large, but on a return per dollar basis, it significantly underperforms stocks over the same time horizon. Now, I want to be very clear. This does not mean renting is always better than buying. It does not mean home ownership is a mistake. What it means is that a house is primarily a place to live, a consumption good, like a car or an education, and the cost of that consumption good should be evaluated honestly. The goal isn't to optimize for the most impressive home. The goal is financial freedom, the ability to retire when you want to, the ability to weather a job loss without catastrophic consequences, the ability to make choices about your life that aren't constrained by your monthly payment. A house serves your life. Your life should not exist to fund your house. I've seen this play out countless times. The couple at 62 with a $600,000 home, minimal mortgage remaining, and $180,000 in retirement savings. House rich, cash poor, unable to retire. Watching their friends who bought smaller, invested the difference, reach financial independence a decade earlier. The house didn't build their wealth, it consumed it. Section 10. What to actually do. Alright, let's get practical. 3 situations, 3 sets of advice. Situation 1. You're still buying. Here's the rule I'd give you. Aim to buy a house at 60 to 70% of what the bank qualifies you for. If you're approved for $600,000, look seriously at houses in the $360,000 to $420,000 range. Not because you can't handle the bigger payment short term, you probably can, but because the full 30-year cost of the gap is something the bank will never show you. And that gap is the retirement you either have or don't have. Yes, this might mean a different neighborhood than you imagine, fewer square feet, a kitchen that isn't your dream kitchen yet. That's a real trade-off, but it's a trade-off with a number attached to it, and that number is around $1.5 to $2 million in lifetime wealth. Also, and this is important, resist the urge to treat your pre-approval as a budget. It isn't. A pre-approval tells you the maximum the bank is willing to risk. It tells you nothing about the maximum that serves your financial interests. Situation 2. You're already in a home that's stretching you. First, don't panic. You're not trapped. But you do need to be honest about the math. If you're in a home and you've been consistently unable to max or even meaningfully contribute to retirement accounts, the home is likely the reason. The question isn't whether you feel financially stretched, it's whether your housing costs are crowding out your long-term financial security. Consider running the full cost accounting I outlined above for your specific situation. What is your home actually costing you annually when you include taxes, insurance, maintenance, and utilities? What percentage of your take-home is that? What would be left to invest if you downsized by $150,000 to $200,000 in home value? If the numbers show you're consistently short on retirement contributions, downsizing should be on the table. Not as a failure, as a reallocation. You are moving equity from a low-return asset into a high-return investment portfolio. That is a financially rational choice, even if it doesn't feel like one emotionally. Situation 3. You own a home and are doing reasonably well financially, but aren't sure whether to invest extra money or improve the home. Default to investing. Home improvements very rarely return their full cost in home value. A $40,000 kitchen renovation might increase your home's value by $20,000 to $25,000. The other $15,000 to $20,000 is consumption spending. which is fine if you're prioritizing enjoyment over financial return, but do it with eyes open. If you're debating between a $25,000 bathroom remodel and maxing your Roth IRA and brokerage contributions for 2 to 3 years, the Roth IRA wins on pure financial logic. Not close. Section 11, the freedom question. I want to close by reframing what all of this is actually about. The point of this math isn't to shame you for buying a nice house. Nice houses are nice. Having space for your family, a yard, a kitchen where you enjoy cooking, these have real quality of life value, and quality of life is not nothing. The point is that financial freedom, real freedom, the kind where you can choose whether to keep working and aren't working because you have to, that freedom has a price tag. And one of the biggest accidental ways people pay that price tag without realizing it is with their housing decision. When you buy a house you can genuinely, comfortably afford, not just make the payment on, but absorb all the costs of, invest adequately around, and maintain without financial strain, you preserve options. You keep the future open. When you buy a house that saturates your cash flow, that crowds out retirement savings, that creates maintenance shocks you can't absorb, that inflates your lifestyle spending in ways you didn't anticipate, you close options. You trade your future flexibility for present-day square footage. Most people I've talked to who made the modest housing choice early on, who resisted the pre-approval number, who bought the sensible house in the solid neighborhood instead of the impressive house in the aspirational one, they don't regret it. By 50, their investment accounts are large enough that work feels optional. The house isn't their identity. Their freedom is. The people who stretched, many of them are brilliant, hardworking, genuinely good at their jobs. They're still going in every day at 58 because they have to. The house is beautiful. The retirement account isn't ready. That's the trade. I just want you to make it consciously. Either way, you'll know. And knowing is worth more than any pre-approval letter. If this gave you a different perspective, if it reframed something or made a number click that you'd been avoiding, hit subscribe, like and share, send it to someone who's about to buy. The best time to understand these mechanics is before the papers are signed. Your future self will thank you.